2nd is broadcast on New Jersey 12 Network every Saturday mornings at 8 a.m. Rebroadcast after the news at 6:30. It's a half-hour show. Every other Sunday night, it's on CW11 on the CW11 channel, New York. So at 6:30 every other Sunday night. So she's not only the host of my show, she's the host of like 50 other advisors. And the fact that night at dinner, she was asking me all these questions, and I had no idea. I was just answering them. I thought she wanted to talk about tomorrow's recording of the shows. And she was asking me questions, and I had no idea. And then when we got home, she called me and said, hey, I think I want you to look at mine and Charlie's stuff, her husband, and do your DPS report for us. And so I did, and they became clients of mine. So she could choose from anybody. You know, we're not the largest advisors around here. You know, in the country, there's other advisors that are bigger practices, multiple advisors. We're a small little family-run business, and I'll give you a little bio about us in a little bit. And she chose us, me, which is pretty cool for me. And I didn't take that lightly, that she could pick anybody, and picked us. And so we're happy about that, and she actually was willing to do an introduction. I would like to just talk to Chris about it. We got to cut out the clap thing at the end. I don't really need to do the clap thing, but it's a pretty cool introduction because here's a lady from Charlotte, North Carolina, who's a client of ours at DPS Advisors, and she could pick any advisor in the country to work with, and she worked with us. So you heard on the show, if you were paying attention, one real quick question. Who's looking at the color of the jacket I was wearing on the show? Did you notice? I said to my brother-in-law and my son, I go, I'm wearing the same jacket that I was wearing on the TV show. So I promise you, I have other jacket colors and suit colors. I am not just a one jacket advisor, but I'm like, oh my God, we picked a show that I'm wearing the same outfit. So with that being said, let's get going. We have a really nice room tonight. So I'm gonna ask, we wanna get out of here in an hour, try and keep you, we respect your time. Because we have a full room, if you have any questions, jot them down on the sheets that are there. If you need paper, we have a pad available. Jot your questions down. We'll stay afterwards, and you want to ask questions, we'll answer any question that you have. So while we're going through the topics, just jot the question down, okay? If we are running good with time, then maybe we will say, hey, anybody got any questions? And I'll answer them, you know, right here, okay? Keep the questions personal. I mean, don't make them personal. Because what we're talking about tonight is in general. If it's personal to you, ask us privately after everyone's gone, or just come grab me on the side and we'll answer any kind of personal question that way, okay? So with that, you guys, this is a compliance screen. I know you can't read it, don't worry about it. What it's saying here is, whatever we talk about tonight, you are not going home and deciding to change your financial plan based on what you hear tonight, because we're talking in general. If we're gonna work with you, it's gonna be personal, one-on-one with us and you together in our conference room or on Zoom or whatever you prefer, and then we'll give specific advice to your situation. That's what that says. So you're not deciding anything or making any changes based on what we're saying tonight, okay? So with that, you heard who I am, right? I'm John Papa. I started this practice 39 years ago with my dad. I was a college student, didn't know what I wanted to do, and my dad was selling insurance at the time. For most of his life, he was a hairdresser, but he couldn't do it anymore, so he was selling life insurance. So I interned the agency my junior year, before my senior year, and knew I hated selling life insurance, but I liked investments. So I said, why don't we do this? I'll do investments, you do the insurance on all the companies, small businesses, you heard pizzerias, body shops, restaurants, companies that don't have the big administration like a Novartis and whoever. You know, we went in and set up 401k plans like I was talking about. I handled the investments, he handled the insurance on the owners, and we ran that practice for a long, long time. He passed away 5 years ago. He was working all the way until the end, but really didn't work for the last 10 or 15 years. But that's what we did. And then we started switching our practice into doing planning for people in the room right now. How we pay the least amount of taxes. So it's a family-run practice. 2 years ago, my son graduated college, or maybe 3 years ago? 3 years ago. Wow, you're getting old. 3 years ago, my son graduated college, and I think when he saw the senior year come in, he didn't know what he wanted to do. I got a call one day and he said, hey, I think I want to come into the business. I'm like, wait, me and Mom are coasting right now. What do you mean you want to come into the business? So he decides to come in, and now we got to regroup, we got to remarket. We started our TV show, radio show, and our practice has really skyrocketed. Thanks to him coming into the business. So he works for me. Ted's my brother-in-law. Started working for us almost 2 years ago now, right? It's almost 2 years? Ted's my brother-in-law, married to his sister. So there's a lot of things I can't say when we're in the office because it'll get back to her. But so we joke around, we have a good time. I just hired my daughter out of advertising. She is now our director of operations because you can see I'm not the best technology guy. She keeps us in line technology-wise. You guys have all talked to Sue in the back. Sue is like my second mother, my second wife, my second sister. She's been with me for 21 years. I don't know how she needs a medal for that, how she put up with me. So we're really, truly a small little family-run business right here in Roseland, New Jersey. We manage about $350 million to $400 million of client assets, just like people like you. I don't have $100 million clients. I got hardworking, middle-class people who are clients. And our motto that me and my dad started 39 years ago is educate and empower people so they can make a better decision with their hard-earned money. That's why we use libraries. It's education. We don't pressure anybody to do anything. We don't pressure you to come into our office and take an advantage of getting an analysis done for yourself or your family. We don't pressure you to, oh, we did all this work, you got to work with us. You could take our information and walk out the door, and not that I could care less, but we're not going to say a word. We're okay with that. We started this a really long time ago, and we're not stopping now. We keep that motto, okay? So I just explained what we do, so I'm going to have to do this video. We're not just brand new in this business, 39 years, right? Anybody know Fox Business? You know the show, the channel Fox Business? Anybody watch that?
Fox News.
Fox News. Well, they have a Fox Business channel as well. Every Sunday afternoon at 2 o'clock, they have a show called the Wealth Counsel. They bring advisors in from across the country to talk about the stuff we're going to be talking about tonight. I've been on 5 episodes of the Wealth Counsel on Fox Business as one of the advisors on the show talking about different things that affect people who are 50 years old and above. CNBC, Sunday mornings, or Saturday mornings, they do a show called The Worldwide Exchange. It's broadcast in 90 countries. I was on 2 episodes of The Worldwide Exchange as a retirement planning expert. My segment was at 5 a.m. to 6 a.m. So I got picked up by their car service at 4 o'clock in the morning, went out, it was actually during the week, the show, went out, did the show, they drove me back, and my whole house was still sleeping. I got up, showered, put a suit on, went to Englewood, went to the studios, did the show, came home, everybody slept. I'm like, you guys, I'm like the Marine. I do more before you wake up. So we joke around with that. So I've been on CNBC. I'm on WPIX. I've written articles for MSNBC, MarketWatch, Benzinga. I wrote a book called Avoiding the Retirement Traps, the 7 financial mistakes retirees make with their money. We're writing a book now called The Intelligent Investor because we want to start talking to the younger people. Don't make the mistakes that you guys are going to hear about that you've made by doing 401ks, 403bs, 457s. That's not the retirement plan. That's not the retirement plan of the future, and it should not have been the retirement plan that we all sold to everybody back in the day. We'll talk about that. So, we're licensed fiduciaries. Okay? Licensed fiduciaries. Does everybody know what that word means? Our standard of care for a client is up here. If you're working with somebody at one of the big box firms, they're probably just brokers. Okay? Their standard of care is down here, and I'll give you a quick analogy. You need to hang a picture on your wall. You need a hammer. You call your big box firm advisor and say, I need a hammer. They sell you a 20-pound hammer. That's a suitable recommendation. You ask for a hammer, they sold you a hammer, and they go on their way. You cannot get in trouble for that. My standard of care as a fiduciary, I probably get fined for that if you complain about what just happened, because we're Home Depot. You tell me you need a hammer, I'll go take you to the aisle with hammers, We have little hammers, sledgehammers, 2-pound hammers. I got to ask you some questions. How's your health? Any orthopedic issues? Any heart issues? Any cancer? Any medical condition that I need to know about to find out what hammer you can work with? So we, as the fiduciary standard of care, is way up here. So we will find you the financial tool that you need for whatever job you're trying to accomplish, whether it's market volatility, lowering taxes on your plans, creating income in retirement, things like that. We find a tool that works for you with your best interests over our own at all times. That's the fiduciary standard. If you get one thing out of tonight, it's make sure you're working with a fiduciary, because you worked your whole life for this pot of money that you have. You deserve to work with a fiduciary. There's an easy way to find out if you are working with one. You go home tonight, call tomorrow. Hey, Mr. Financial Advisor, got a quick question for you. Are you a licensed fiduciary? And if the answer is yes, great. That is awesome. I'm so glad to hear that. Let me ask you, which kind? Because there's only two. Registered Investment Advisor, RIA, or a Certified Financial Planner, CFP. So just follow up with a second question. Which kind are you? And if they're not a CFP or an RIA, they are not a fiduciary. I had a lady tell me, she goes, I listened to you, I called the next day, my guy, I'm so happy, he's a CFP, he's a fiduciary. Okay, great. We did her analysis, and I asked her for her statement. And her statement had the guy's name on it. Didn't say anything. If you're a CFP, you get a trademark designation. RIAs don't get that. You're just licensed with the SEC. You don't get a license designation. Trademark. Every CFP I know puts it on every piece of material they give out to a client. I just asked her, don't you think he would have put it down there if he was a CFP? So why do you think he did that? So I don't think he is a CFP, but who am I to argue? So if you get one thing, that's what you got to get. All right, we're going to talk about a couple of topics tonight. One of them, the first one's going to be about Social Security. A bunch of information about that Ted's going to handle. I'm going to talk about the tax planning stuff that you guys watched the show on. And then Luke's going to talk about market volatility, then we'll wrap up. We should be able to do that by 7:30. And then I might throw also one other topic on long-term care. Does anybody care about long-term care? One person, 2, 3, 4, 5. So if we have maybe an extra 5 or 10 minutes, I'll talk about long-term care. If you want to stay late, stay a little after, okay? I'll ask that question when we're done, all right? So Ted's going to come up and talk about long-term care, Social Security. So one thing you're going to find out, we're like the fun show. Like, we make mistakes. You guys can laugh, because I'm going to, if you guys come on as clients, I'm going to make fun of you. You can make fun of me. That's perfectly fine.
We make mistakes?
Well, you make mistakes. Okay. Yeah, I don't make mistakes.
Thank you, John. Welcome, everyone. As John said, I've been with DPS Advisors for just under 2 years now. Been in the financial services industry for over 30 years. So when John and Luke joined the team, they wanted to grow it. They called me in, asked me if I wanted to join the team as well. So it's been a great 2 years. As you said, we're in growth mode, but we're out here really spending a lot of time educating and empowering people. I, as the new guy, have the fortune of talking about Social Security. Now, Social Security, if you know anything about it, there are over 2,700 rules that govern Social Security, and there are over 9,000 different ways that a married couple can file for Social Security. So John wants me to talk about all of that within 5 to 10 minutes as the new guy. So wish me luck.
So hurry up.
The clock's ticking?
Yeah.
Okay.
Because they're looking. He's looking at his clock too. I saw him watching his clock before.
There are really two questions that people have when it comes to the Social Security. With all those big numbers, the two questions that everyone asks us when they come to meet us is, will Social Security be there for me when I need it? And the answer to that is yes, but. The second question is, when is the best time for me to claim or to file Social Security? And the answer to that one is, it depends. So a lot of concrete information you're going to get on those two things. For the first question, we're going to go about 90 years back. We're going to give you a quick history lesson. 1935, FDR enacted Social Security. And at the time, they chose 65 as the full retirement age. They kind of looked at what Germany was doing at the same time. They thought 60 was too young, 70 was too old, so they went with 65. Can anybody tell me what the average life expectancy was 90 years ago in 1935 for the people who lived long enough to get into Social Security?
67.
So the overall life expectancy was 59 and a half. For people who lived long enough to begin to contribute to Social Security, it was about 65 to 70. So they weren't expecting people who were contributing to Social Security to collect for very long at all. Right? If you think about it, the full retirement age was 65. People were only expected to live to 65, maybe 70. Right? So here we are, 90 years later. The full retirement age, they've only increased it to 66 or 67, depending on what years you're born. But the average life expectancy now, can anybody tell me what the average life expectancy is nowadays? It's about 74, 75, 76. Women live longer than men, right? About 5 years longer on average than men. We're not going to debate why that is tonight in this class. It's for another class. But the average life expectancy is about 76 years old right now. So people are living a lot longer in retirement. By 2032, for the first time in the history of the country, there are going to be more people who are 18 years and younger. There's going to be more people 65 and older than there are 18 and younger. So what that means is for Social Security is there are already more people taking money out of the pot than are putting money in. So if you've heard the expression Social Security is going bankrupt, what it really means is the trust fund that's been built up for the last 90 years as people were paying into it is getting depleted. And if Congress doesn't do anything by the year 2032 or so, the trust fund will be empty, but there are going to be people continuing to contribute. Now, as long as everybody in the United States doesn't stop working, people like young, handsome Luke back there are going to be the one contributing for all of us. But the big thing is, when they enacted it, there were 40 people contributing to every one person taking it. By 2032, there's only going to be like 2 or 3 people for every person contributing it. So Congress can raise the full retirement age, which they may do. They've already done it a little bit. Or there's something called the Social Security wage tax. If you look on the top right of the screen here, you'll see that in 2024, the wage tax was $168,000. 2025, it's $176,000. And what that really means is, if you make $200,000, if you make $1 million a year, for the purposes of Social Security, the 6.25% that's taken out in your paycheck that goes to FICA, which is the Federal Insurance Contributions Act, they only take that money up to the Social Security wage tax, or the maximum. So they can continue to raise that, which we feel that they're probably going to do. They're probably going to raise the age of full retirement age. Some things that they can do to help balance out the equation that's going on right now. If they don't do it, something that you think you need to talk to your financial advisor about, whoever that is whatever your expectation is for the number that you're expecting to get on a monthly basis for Social Security, if Congress doesn't do anything by 2032, 2033, that expectation, whatever you were going to get, can be cut to about 79 or 80% of what you were supposed to get. John's going to talk more about inflation, but if you think about it, in another 8 years, if your Social Security is cut 8 years from now when prices are higher, that's a bad equation. So it's something that you need to prepare and plan for. All right, so the second question was, when's the best time for me to begin to claim or file? And I said it depends, right? Because everybody in this room, although we're probably all in the same age category or so, John's a lot older than I am, but we're kind of in the same group.
Who thinks that?
Everybody's situation is unique, right? It's probably a strange thing for a financial advisor to tell you to talk to your physician, right? But If you have longevity in your family, like my parents are both 85, they're both still alive. I had a grandfather that lived to 95. So from a financial perspective, for myself, I need to plan to live till I'm about 85 years old, at least, right? So if you have good health in your family, the good news is the fact that you're all in the room here tonight, your life expectancy right now for women is probably about 89, and for men it's probably about 84 years old. So the good news is that you're probably going to live long. You just need to prepare. And one thing we always say to our clients is we want to make sure that in retirement, your standard of living is no lower than it is right now, right? So talk to your physician. Find out about your health, your chances for longevity. Then if you're married, right, who is the spouse that's making more money? Who's the spouse that's working longer? Who's the spouse that's older? Are you financially taking care of adult children? Or, they call us the sandwich generation. Are you financially taking care of parents who are still alive? So everyone's situation is unique. Do you need the money? If you take it at age 62, which hopefully everyone knows is when you first become eligible to take Social Security, you'd get about 75% of what you should get if you waited to your full retirement age of 66 or 67. However, if you can wait to the age of 70, you're going to get about 132% of what you would have gotten had you taken it at your full retirement age. There's something called delayed retirement credits between the age of 66, 67, and 70. You're guaranteed an 8% bump each of those years at a time when you're probably going to be conservative in your investments. So that 8% bump, could be significant for you. So, everybody's situation is unique. If you can afford to wait and you don't need the money at 62, we're going to give you a math problem that's purely math to show you what the difference could be for you as a married couple over a long period of time. Now this is, everything that I just talked about, this is kind of excluding all of those other things. From a math perspective, we have a couple, Ron and Nancy, 60 and 58 years old. Ron's life expectancy as a 60-year-old man is 85 years old. Nancy as a 58 would be about 90. So in each of these three scenarios, Ron lives to 85, Nancy lives to 90. If they both take their Social Security at the age of 62, the monthly benefit for Ron is $1,900. For Nancy, it's about $1,400 and change. The cumulative value of all of those benefits is about $1.65 million, right? However, if Ron and Nancy both are able to wait until they're 67 or their full retirement age, you're going to see that the monthly benefit is $3,000 for Ron. Nancy, it's $2,200. The cumulative value is $1.9 million. It's almost $280,000 more, even though it's over a shorter period of time. And then again, Ron and Nancy, if they wait until 70 because of those delayed retirement credits that I mentioned earlier, it would be a total of $2.126 million, or about $400,000 more than the age of 62. Again, pure math, right? What you want to do, if you recall, we used to get those mailers. Social Security used to send you out those paper statements that tell you what you're going to get at different ages. If you don't know now, you can go to ssa.gov, right? ssa.gov. It's very easy, believe it or not, to just create your own log on. Instead of getting the paper statement, you go on, you find out for yourself at the age of 62, at your full retirement age, or at the age of 70, and any age in between, what you can expect on a monthly basis. All right, so that's again, that's a 10-minute version. We literally, Social Security, you could be here for hours, answer questions. We're going to be here afterwards. John, I'll turn it back to John, and you're going to talk about taxes now,
We're going to
right?
talk about taxes on qualified plans first, but we're running pretty good on time, so if anybody has a question or two, we'll take a question or two on Social Security. Does anybody have any questions about what Ted just said? Yeah.
The only question I have is, are you a resource available through DPS should I choose to use you as a fiduciary? I guess that's what my...
A resource for, in what way?
A resource to help guide me through this decision.
You haven't gotten the answer to that question yet already? After everything you've seen so far?
I know you're a fiduciary.
Absolutely. So the answer to that, again, we like to make fun of people. You'll make fun of me. I wear the same jacket. We like to make fun with our clients. We like to have a good time. Yes, we are your resource.
Okay.
And the topic I'm going to talk about is another topic, another area of resource. Because I'm going to ask a couple of questions. And you'll see how the way we run our practice, because we are licensed fiduciaries, is totally different than the big box firms and the CPAs that do taxes on a regular basis. So yes, we are, to answer to your question, the short answer.
Thank
So, with a little joke in there, right?
I got it.
So,
I have a sense of humor.
Did somebody else have a?
yeah, anybody else have a question on Social Security? Ted did a really good job in 8 minutes, I was measuring.
No mistakes either, right?
No mistakes. So, who here, we were watching a show before about taxes on qualified plans. That's your retirement plan. IRA, 401k, 403b, 457. Who here in the room has put money away, got a tax deduction for it, and the money is growing tax deferred to pay taxes at a later date in one of those plans? Who here? Raise your hands. Whoever has them, raise your hands. Almost everybody in the room. Okay? Almost everybody. Who here has sat down with their financial advisor and said, okay, how are we going to make the distributions on these qualified plans? That's what they're called, qualified plans. And we pay the least amount of taxes to the IRS. Who sits with their advisor and creates a plan to pay the least amount of taxes? One person in the room. Perfect. There's always one. And that's great. Good for you. Most people don't do that. And you're going to hear some numbers tonight and think to yourself, why aren't I doing that, right? So we'll talk a little bit more about that. Are there any CPAs in the room that do personal tax returns for people on a regular basis? Any? Good, okay. So sometimes there's one or two, and I got to apologize. I'm going to say some stuff tonight. I don't mean you, but I'm going to say some stuff that. All right, so no accountants in here. Who talks to their CPA in September and October to come up with a plan to pay less taxes next year or in the future than they are paying this year? Who does tax planning, except for the gentleman in the back? Who does tax planning with their CPA? That's great. So most people, they gather all their stuff in January, February, they get it off to their accountant, and back in the day, you would give it to him or her, and she would call you in a week or two, and you would go pick it up, and you'd have to put it in the mailbox, post-stamped by April 15, but now it's all electronic. So you would see your accountant twice, because you had to pick the stuff up. Now you only see him once, and then it's like, I'll see you next year in February. There's no tax planning being done. Is that like most of you here? Okay. So that means you're dealing with tax preparers and not tax planners. I'm going to talk to you about, and what you heard in that show before was an example of clients of ours that have an IRA and have some years to go before their RMD kicks in. Who knows what the letters RMD mean? You got to stop raising your hand. I'm not calling anyone out. No, you don't have to leave. But stop. I know you. I'm teasing. So RMD means required minimum distribution. Okay? And for most of our working lives, do you remember the age 70 and a half? That was when you had to start the RMD. There was two ages you had to know about. 59 and a half was the earliest you could go into it without paying a 10% penalty. And 70 and a half was, that's when you're going to have to start taking money out. Well, in the last couple of years, the IRS and the Secure Act actually raised that. It's now 73 years old. And in 2035, it's going to 75 years old. Why is that? Because we're living longer, right? And it allows the monies to grow a little bit more because they're untaxed. Now, what does the IRS get with more untaxed dollars? More tax revenue, right? So, no one's doing, except for one, most of you are not doing tax planning. Most of you are doing the plan that the IRS has set for you. So is their game plan pretty much going to hang out, let it grow, and then once we reach RMD age, start collecting the distributions? Right? That's pretty much the plan? Okay, so we had a couple come in from one of our shows. It might have been a TV show, I'm not really sure. They come from, you'd be surprised how many people listen to the radio. We get so many calls from WOR 710 on Sunday afternoons. It's crazy. I don't think anybody listens to the radio anymore, but they do. So a combination of how we talk to people, right? We get a lot of people coming in here talking about tax planning stuff. So this couple came in and they were 65 years old. And they had $500,000 inside of their IRA, okay? 65 years old, $500,000 in the IRA. That's not crazy, right? We live in North Jersey, been saving for a really long time, company match, right? It's not crazy, but the numbers work no matter how much you have in the IRA. But this couple had $500,000, all right? Ask them the same question. No tax planning strategies, don't talk to the CPA, whatever. So their game plan was to wait till 73 to do the distributions. They're earning 7% on their money. That's a fair interest rate, right? We're not crazy interest rate. If your advisor can't get you 7% in today's markets, that's another reason probably to change, right? Because money markets are paying 4%, right? So if you're 7% return on your IRA, so you play the game the IRS says. At 73 years old, that IRA is now worth $860,000. You let it tax defer, you let it grow, you didn't panic on market downturns, and it's worth $860,000. And now the game begins. And now the IRS starts collecting, okay? So the first year's distribution is $35,000 you have to take out of that IRA, whether you need it or want it. Okay, some people don't need the IRA. They want to just keep letting it grow, but they can't. They have to take money out because the IRS wants to start collecting taxes. One other question real quick. Where do you think tax rates are going? I should have asked this before I started this topic, but where do we think tax rates are going? So I get so excited I missed the slides. Where do we think tax rates are going? Our country, this slide was 6 months old. We're not $36.5 trillion in debt right now. We're $37.5 trillion in debt. Where do we think tax rates are going in the future? Not the next 2, 3 years, 4 years. Next 5, 10, 20 years. Who thinks they're going down? Who thinks they're going up? A lot of people think they're going up. And I mentioned on the TV show Ronald Reagan. You guys remember Ronald Reagan? He was an actor before he was a president. He did a movie for $1 million and paid $900,000 in taxes on that $1 million salary for the movie. I think that's what propelled him to politics, because he didn't want to do that anymore. So we're $37.5 trillion in debt. The government doesn't make anything. They only collect tax revenue to pay down this debt, right? How much money do you think is sitting in your 401k? You total it all up, everybody in the United States. Yours, add it all up, right? How much money you think is sitting in there untaxed that you know Congress knows about? How much? Throw a number out.
200 trillion.
40 trillion. $40 trillion is sitting in untaxed revenue. You don't think with a stroke of a congressional pen, tax rates for distributions of IRAs and qualified accounts can change? So I did it myself. I started in this business in 1986. You guys were all working in 86?
Yep.
If you did a distribution from your IRA in the late 80s, you didn't just pay federal taxes and state taxes. There was a third tax called an excise tax. Okay? Stroke of a congressional pen, Reagan was in office, that went away. Now we're where we are today, stroke of a congressional pen, that could come back. Right? So we all think, and most accountants that we work with and estate planning attorneys we work with agree that in the next 5, 10, 20 years, tax rates are going up, okay, on these qualified plans. So if your plan is considered a tax-deferred account, right, that's what they're tax-deferred, you're paying it later. When do you want to take money out of a tax-deferred account? When tax rates are high or when tax rates are low?
Lower.
You want to take them out when they're higher? That's a general question. I'm not asking you what your opinion on what you think yours is going to be.
No, you're asking a question with only one part of the equation.
No. Tax rate? No, I'm not.
Okay.
I'm saying, when do you want to take taxes, when do you want to take your money out of a tax-deferred account? When tax rates are low or when tax rates are high? That's a simple question, right? When tax rates are low. Right now, we're in the lowest taxable environment we're going to be in the rest of our lives. I've talked to accountants, CPAs, and estate planning attorneys on a regular basis. There's not one that says, keep tax deferring it till 20, 30 years down the road, you're going to be in a lower bracket. And there's not one that says, when you pass on your assets, because we're going to talk about that in a second, when you pass on your assets to your kids like Luke, and they have to take the money out in a 10-year period, there's no way they're going to be in a lower tax bracket. Impossible. So if it's a tax-deferred account, and the answer that most retirement people say is, take it out and tax rates are low, that's right now. So why are we going to continue deferring? Here's the problem. You wait the 65-year-old couple waits 8 years, their account's worth $860,000. Okay, we're saying people are living longer, so let's just assume they're going to live to 90. Okay? If they live to 90, they're going to pull out $1.1 million in distributions. $35,000, $37,000, $40,000, $43,000. It increases every year. Okay, by the time they're 90, they would have collected 1.1. And let's not even change the tax bracket. Let's say it's 24%. That's today's tax rate, right? 24, is that fair to use 24?
Yeah.
Okay, they're going to pay $265,000 in taxes on that $1.1 million in distributions, right? Doesn't end there. Doesn't end. There's still $1 million left. Now you pass away at 90. You have Luke as your son, your child. He inherits that IRA. He doesn't add it to his IRA. He has to open up an inherited IRA. Anybody know, familiar with inherited IRAs? Okay, if you ever inherited something from a deceased spouse, parent, grandparent, if you inherit one of their IRAs, you don't put it in your own IRA. It has to go into an inherited IRA. Why is that? Because the distribution rules are different than your IRA rules. So when Luke gets your $1 million that's left in this IRA, he has to take it out over a 10-year period. So let's say that happens, he's 65, 90, it's 25 years. So Luke's 25 years old. He's 50 years old now, probably in the prime working years of his career, probably the prime income earning years in his career. And now he inherits your IRA with $1 million and has to take the distributions out every year for 10 years. That's $100,000 in income. Could that possibly bump him into a higher tax bracket? Let's say he has to pay 30% on those distributions. He's got to pay $310,000 in income taxes on your inherited IRA. Now granted, he has no skin in the game. Probably these young kids could care less. They'll pay the $310 and not worry about it. I'm going to net $700, great, I'm good. I might take it all out in 1 year, forget 10 years, right? Because they don't care, they don't have skin in the game. You worked your whole life for that IRA. You're going to try and do what's best for you. Your kids who inherit it, blow it quick. But that doesn't mean they're not paying the taxes. So that IRA that you had $500,000 at 65 years old, your family is going to pay $574,000 in income taxes on your IRA if you play that game. That's pretty crazy, isn't it?
Yeah.
Okay, well, what are my options? No one's talking to their advisor about tax planning strategies. No one's talking to their accountant, except for one gentleman in the back, and this lady here, I'm sorry, about tax planning strategies. So most of you are not even doing anything about it. So if you play this game, you're paying the most amount of taxes you can to the IRS. The IRS tax code book is 30,000 pages long. It's there to make us learn strategies to pay the least. There are ways to legally do it and pay less taxes. What if I can show you over the 8-year period, we do a distribution of $78,000 between 65 and 73. I take the $78,000 out, I move it to a different account, and I grow it in that account. Over the 8-year period, you would have had distributions of $626, and you would have paid taxes of $150,000. You will then grow the money as we're converting it over, and your $1 million IRA is now tax-free IRA. And now you take all your distributions, 35, 39, 41, all the way down to age 90. Then you pass away, and there's still $1 million left in that tax-free account. That will now go to Luke. But now, still has to do it over a 10-year period, but now he gets the $1 million tax-free. So on that IRA that you do nothing, you're going to pay, your family and you will pay $575. you could pay $150 if you do tax planning. And then if you really want to get advanced tax planning, what if I can show you a way to pay $62,000 in taxes instead of $575? Who would be interested in that? So you got 3 doors. Think about this. You're retired. You're right now 65. You come into our office. You tell me you have an IRA worth $500,000. I'm going to say to you, hey, you got 3 doors. One door, you and your family are paying $575. Door number 2, you're going to pay $150. You and your family. Door number 3, you're going to pay $62. Which door do you want to pick? I haven't found one person yet say door number 1. But what's not happening is you're not looking at the analysis. You're not, I've been in this field, I've been dealing with people 50 years old and above for 35 years now. You guys hate change. I know it, we know it, I've been dealing with it for 30 years. I could show you all these great strategies and great things, but if you don't have an open mind and you, number one, don't take an advantage of coming to see us in our office for an hour personal meeting for no cost, no obligation, and let's run your numbers. Every one of you said you have one, and every one of you said you're not doing tax planning or your accountant's not telling you. So if you're not taking us up on your offer, you're going to be just putting your head in the sand and paying $575. So I promise you, when we talk at the end of the night, we're going to offer this opportunity. We'll run your numbers and see what we can do for you. I'm not saying it's right for everybody. I know nothing about anybody in this room. It's not right for everybody, but find out if it is, okay? So, we're going to bring Luke up and we're going to talk about market. Any questions? We're still doing pretty good. Any questions on tax planning? Yes, sir.
Those examples you gave were from age 65.
65 to 73. That was the client age, yeah.
So I'm older than that.
Yeah, it could be.
It's still...
Yeah, we run the analysis. I don't know how old you are. Don't have to tell me how old you are. We'll run your analysis.
I'm past 39, okay?
You know, I would never tell.
Okay.
But no, we'll run the numbers based on your situation.
So I'm over 75.
Okay.
So those examples and what could be done, still could be done at a later age.
Yes. I mean, the benefit's not going to be as great, and it really depends on, do you need the IRA for money? Do you not need it? So there's a lot of other things we would talk to you about in that situation and see if it's worth it for you. It could be, it might not be, but at least you get an answer, right? So that's what we're saying. Yeah, so it could be or it could not be. Yes, sir.
Your strategies are beyond Roth conversions?
There's other, yeah, so we're going to talk, again, I'm late on the slides, sorry about that. I get talking and I forget the slides. Yeah, so you could sit here and like I just said, put your head in the sand and do nothing and pay door number 1, $575. Or we could pay some taxes now because we know what the tax rates are and do some tax planning. And then there's Roth conversion. There's, the crazy name word life insurance. Again, depending on the situation. I turned 2 teachers' 403B accounts into a tax-free $6 million benefit to their heirs. Because teachers, if you have a pension and you don't really need your tax-deferred account for income for yourself, there are a lot of other options as well as the Roth conversion. Using life insurance, we turned a taxable 403B into a $6 million tax-free benefit to their kids and grandkids using life insurance. So it depends. Again, not for everybody. My job as your financial advisor, fiduciary, is to educate and empower you with every financial tool that's available to you for your job that you want to do. I don't care which one you use. I'm going to tell you the pros and cons of life insurance, Roth conversion, tax-free municipal bonds, all the pros and cons of every financial tool. We're going to go down aisle number 11, and you're going to pick which tool works for you. I don't care which tool you use, but if you don't want me to talk to you about life insurance, then I'm not really doing my job. You got to learn every tool so you can make a better decision. So it's not just Roth conversion, there's other ways to do it. That's a very good question. Any other questions real quick? I'm going to bring Luke up because we're actually still pretty good.
You got one slide left.
I do?
Yeah.
Every time. Every time. All right, inflation, real quick. Inflation. I got one more slide left. All right. So, we talk about this every time. We always forget inflation. So inflation, most people don't attack inflation, right? They don't think, it's not gonna affect me, it's no big deal. But you know what inflation really does to you? So if your expenses are a set amount of money, a set amount, right? Next year, if the inflation rate is 3%, that set amount of money is gonna buy you less goods than it would have if inflation was 0. You guys understand that, right? Okay. Who thinks the inflation rate actually is 3% up here in North Jersey and the Northeast area, right? Does anybody agree with that? I don't. Again, talk to people who are in the economics field. It's running probably close to double digits, but let's say 6%, right? The real number is probably a little higher. Here's what most people don't know. If your expenses are, say, for easy math, $4,000 a month, and inflation's running at 6%, every 8 years, your expenses are gonna double at a 6% inflation rate. So your $4,000 a month expenses is gonna rise to $8,000 a month. That's not buying more stuff. That's buying the same stuff you were buying for 4, but because of inflation, it's costing you 8. We're living longer. 65, 90, that's 25 years. 8, 8, 8. 3 times your expenses are gonna double in retirement. 4,000 becomes 8,000. 8,000 becomes 16,000. 16,000 at close to 90 years old becomes 32,000. You're not buying any more stuff. It's costing you more to buy the same stuff. If you're not factoring in inflation in your retirement income plan, you're making a huge mistake. There are ways to show you using financial tools that you can create a guaranteed increasing income plan throughout your 25-year retirement life. Has anybody heard of that? Is anybody doing that right now? Okay, that should be another thing to check off on that sheet that we're going to talk about in a little bit. We do that every day. And we'll show you how we do that when you come into our office. How do we create a guaranteed increasing income stream throughout retirement? Because if you think your game plan is just to get Social Security and a little bit of assets, a little bit of income off of your assets, that's not going to work. You're going to get hit hard on income. And what's the most important thing people say to us when they walk in? Hey, what's your most important concern? Don't want to run out of money. I don't want to rely on my kids. That is by far the #1 issue we hear when you come into that office for the first meeting. And no one has an income plan guaranteed. Okay, so you're on the path to that. Here's how we're going to get you off that path. If you're not talking to your current advisor about that, you got to ask why. Right? We're doing this 39 years, a really long time. We've been doing it for a really long time. We know how to do that. So that's our quick talk about inflation. Luke's going to talk about market volatility. And I'll, if you guys want, I'll also talk to you about long-term care if you want to take a little bit of time for that.
Thank you, Dad. Market volatility and how it can affect you as you're approaching or already in retirement. Investing in retirement is totally different than investing while you're working. When you're working and receiving an income, you can afford to be aggressive with your investments, and you should be. When you're getting closer to retirement and you're about 5 years out, that's when you want to start shifting to a more conservative portfolio. Once you're in retirement, you really need to worry about market volatility because you can't afford to take a loss in the market and having to take money out of your IRA in the RMD. Once you're 73 and RMDs are due, and you haven't done any Roth conversions, that RMD doesn't care if the stock market is down. And you still got to take money out by December 31st. Let's look at an example of how a loss could affect you. If you lose 10% of your portfolio, it's going to take you 3.6 years at a 3% return to get back to even. At a 6% return, it's going to take almost 2 years. In 2022, both stocks and bonds were down. Has anyone here heard of the 60-40 balanced portfolio? 60% stocks, 40% bonds? Well, that portfolio was down 25% in 2022 because the concept that stocks and bonds have an inverse relationship is a lie. Bonds are affected by interest rates, and in 2022, Federal Reserve started raising interest rates, bond values went down. So that 60-40 balanced portfolio got crushed. If you lose 20% and you are now a conservative investor because you're in retirement, it's going to take you 7.5 years at a 3% return to get back to even. With the RMD being taken out on top of that, it's going to be nearly impossible to do. Let's take a look at another example.